The class started yesterday with the first lecturer. I will be taking all Tuesday class, all things being equal. By way of introduction, my name is Asiwaju Dayobelo. Precisely, or for short, students call me Asiwaju. Tonight, I shall be taking capital structure and theories of gearing. This topic has a relationship with the cost of capital that was started yesterday by Adejuwon. The two topics will complement each other. The more reason we decided that we should allow these two topics to run simultaneously to aid student understanding. Now, having said that, before I go into the topic proper, before we delve into this topic proper, it's a known fact that ICAN has introduced the new syllabus. With the new syllabus, some aspects of strategic financial management has been taken to financial management. Financial management is a component of strategic financial management. Some topics has been taken to skill level. Why the strategic financial management we are required to deal with at the professional level tends towards advanced financial management. Why am I saying this? It's not to scare students. It's to prepare your mind ahead of the exam. In my opinion, the intent of ICAN with this new syllabus is to look at advanced financial management, which is a bit above strategic financial management. Now, having said this, we shall move straight to the topics for today. Okay? Your network is not stable. Is that correct, please? Can somebody reconfirm that the network is breaking?
It is a bit stable for now.
All right, let's go on with the class. Why I normally ask this question is that all of us, we are connected to network. At times, it might be the lecturer network that is having problem. If it is lecturer network, that means all the students must be affected. But if only one student is being affected, that student needs to go and look at his or her own network. All right, Let's go to the business of the day. The first point is, what is capital? How do we define capital? Capital can be defined as money used to create, build, and run a business. You can define capital as the money used to create a business, the money used to build a business, the money used to run a business. That is the simple definition of capital. Item number 2, types of capital. Basically, there are 2 types of capital. We have the equity capital and the debt capital. Basically, there are 2 types of capital. We have the equity capital and the debt capital. What is equity capital? Before I go on, please, for the online class, the lecturer does not have the privilege to see the students, unlike the physical class. So my suggestion to students is that assume you are in a physical class. Get your writing pad, your writing material, and your calculator closer to you. I'm aware that this video will be available next day. However, you can equally jot down some points in the classroom, in the online classroom. One of the benefits of jotting down is that it makes the students to be active in class. For all you care, somebody might log on to this system and is sleeping. The lecturer does not have the privilege to know who is sleeping, who is not sleeping. Somebody can log on to this system and decide to do something else. All right, having said that, we move back to our discussion. What is equity capital? Equity capital is the capital contributed to the business by the owners of the business. Equity capital. This is the money contributed to the business by the owners of the business. The owners of the business are the shareholders. Therefore, equity capital is shareholders' contribution to the business. Number 2, debt capital. Debt capital refers to all forms of borrowing to the business. Any money introduced to the business through borrowing will fall under debt capital. You can have short-term debt capital, medium-term debt capital, long-term debt capital. Also, preference shares are classified as part of debt capital. Please note that somewhere in your book. Also note, preference shares are classified according to accounting standard. Preference shares are classified as part of debt capital. All right. We have explained the meaning of capital. We have explained the types of capital business can use. Our next discussion, what is capital structure? What is capital structure? The capital structure of a company refers to the different types of capital the company has used in running its business activities. The capital structure of a company can be defined as the different types of capital a company has used to carry out its business activities. This will include ordinary share capital, or this can include ordinary share capital, equity reserves, and long-term borrowing in the form of debentures. A company capital structure can include the ordinary share capital, equity reserves, and long-term borrowing in the form of debentures. Sometimes business entity rely on short-term borrowings. Please, can you mute? I don't know if I'm correct. Your speaker is conflicting this class. Is there Ifua? Please mute. Thank you. So the capital structure of a company may include the ordinary share capital, equity reserves, and long-term borrowing in the form of debentures. At times, business entity relies on short-term debt financing, such as bank overdraft and short-term trade credits. We have defined capital structure, the different types of capital a company has used to finance its activity. A company may be financed by equity capital only. A company may be financed by equity capital only. Such company will be regarded as ungeared. Please note that. Please note that a business organization may be financed by equity capital only. In that case, such company will be regarded as ungeared company. Okay, there's a question. What is the difference between equity and equity reserve? I think the appropriate question is, what is the difference between ordinary share capital and equity reserve? That should have been the appropriate question. The ordinary share capital, that is the number of shares the company has issued, multiplied by the value of the shares. That will represent your ordinary share capital. Your equity reserve is part of the profit of the company that is retained and reinvested in the business. Retained earnings is equity reserve. Equity reserve is profit meant for the shareholders, but not distributed to them. Such profits are retained in the business and reinvested in the business. I hope that point is clear, man. All right. All right. We said a company can finance its business with equity capital only. Such company will be regarded as ungeared company. Alternatively, a company may be financed by a combination of equity and debt capital. Alternatively, a business organization may be financed by a combination of equity capital and debt capital. In that case, the company will be regarded as geared company, a geared company. So please note, if the examiner say this company is geared, what the examiner is telling you is that this company is financed by equity and debt. Hence, the company is geared. If the examiner says this company is an ungeared company, it means that the company is financed by equity capital only. Such company has not obtained debt finance. All right. have explained what is capital, types of capital structure of a company. We have explained ungeared company. We have explained geared company. The next item for discussion, risk. What is risk? How do we define risk? Regardless of the nature of your business, there is always risk involved. Now, what is risk really? Risk can be defined as the variability in business return. You can define risk as the variability in business return. You can also define risk as the volatility in returns, the fluctuation in business return is what we call risk. The higher the variability, the higher the volatility, the higher the fluctuation, the higher the risk. We have used three terms: variability in business return, volatility in business return, fluctuation in business return. The higher the volatility, then the higher the risk. Risk can be classified into two: business risk and financial risk. Risk can be classified into two. We have the business risk. The business risk is the variability of the firm's operating income, the variability of the firm's operating profits, the fluctuation in the firm's operating profits. Business risk is associated with the nature of the business the company is involved in. Business risk is associated with the nature of the business a company is involved. It is associated with the industry sector a company operates. For example, if you look at the banking sector, there is a peculiar risk with banks. Banks are exposed to high rate of fraud. Either internal or external. If you look at the bakery business, bakery products, particularly bread, is highly perishable. If you bake a bread today, within 2 days, in fact, after the next day, some customer will not buy. So there is a risk that if you produce bread, because next day, 2 days later, it could get spoiled, and you are losing income. That means if you find yourself in that environment, if your line of business is bakery business, you must be careful not to overproduce bread, because overproduction will result in loss of income. Because of the nature of the business you find yourself. All right. Financial risk. Financial risk is the additional variability in returns to shareholders. This is the additional variability in returns to shareholders that arises because the capital structure contains debt finance. Financial risk. We said this is the additional variability in returns to shareholders. Financial risk arises because there is debt capital in the company's capital structure. Financial risk is purely associated with debt capital. In other words, where a company is financed by equity only, in other words, where a company is financed by equity only, then the financial risk will be zero. If a company is financed by equity only, that means the company has not borrowed money before. Once you have not borrowed money before, your financial risk will be zero. A quick recap of what we have explained. We have explained what is capital, the types of capital. We have explained capital structure of a company. We have explained risk, the type of risk, business risk, and financial risk. Our next discussion, measurement of financial risk.
Sir?
Somebody is conflicting this class. Zoom user, do you have any question or comments? All right, measurement of financial risk. How do we measure financial risk? The financial risk of a company. The financial risk of a company's capital structure can be measured by gearing ratio, debt ratio, or by interest cover ratio. You can measure the financial risk of a company's capital structure using financial gearing ratio, debt ratio, or you can use interest cover ratio. What is financial gearing? Financial gearing shows the relationship between shareholders' fund, equity fund, and prior charge capital. Financial gearing measures relationship between the shareholders' funds, that is the equity funds, and prior charge capital. Look at it here. Financial gearing indicates the degree to which the company's activities are funded by borrowed funds. The extent to which a company has borrowed money is what we refer to as financial gearing. The proportion of debt capital in the company's capital structure, it is what we refer to as financial gearing. The extent to which a company has borrowed money is what we refer to as the gearing position. We can use financial gearing to measure the level of financial risk a company is exposed to. We can use financial gearing to measure the level of financial risk a company is exposed to. Calculation of financial gearing. You can calculate financial gearing using book value approach or market value approach. As much as possible, please try to log down the important thing here. If you are to calculate financial gearing, you can either calculate using the book value approach or you can calculate using market value approach. This is the calculation of financial gearing using book value approach. What is book value approach? That is the financial statement values. We also call it balance sheet value. The value as stated in the company's balance sheet. That is what we refer to as the book value approach. You can calculate financial gearing as prior charge capital divided by equity capital, including reserves you multiply by 100 in percentage. The prior charge capital divided by equity capital, including reserves. Your prior charge capital is debt capital plus preference shares capital. Your prior charge capital is your debt capital plus the preference share capital. Please note this. You can also use the second method. Financial gearing is equal to prior charge capital divided by equity capital plus prior charge capital. Or you can use prior charge capital divided by total capital employed. Any of these three formulas can be used. In most cases, examiner will specify the formula to use so that we can have uniform answer. In most cases, examiner will tell you the formula to use. Minister of Finance, you are welcome.
Thank you, sir.
If you can dream it, you can hold it. So we have Minister of Finance on the on this platform. All right. So the examiner will specify which of the method to use so that students can have the same answer. So you can measure financial risk by calculating the financial gearing. You can also calculate your gearing ratio using market value approach. In this case, market value of prior charge capital divided by the market value of equity. Or you can use market value of prior charge capital divided by the market value of equity capital plus the market value of prior charge capital. Of course, you are going to convert to percentage by multiplying your answer with 100. So we can measure financial risk by using financial gearing. What is the significance of financial gearing? Why should investors pay attention to the financial gearing of a company? Assuming you want to invest your money in a company, you want to invest in equity shares of a company. Why must you pay attention to that company financial gearing? Let us look at the significance of financial gearing, really. Financial gearing is an attempt to quantify the degree of risk involved in holding equity shares in a company. If I want to invest in First Bank shares, I will just invest in First Bank shares. I need to go and look at First Bank shares financial gain, because that will give me an insight as to the amount of risk involved in buying First Bank shares. It's an attempt to quantify the degree of risk involved in holding equity shares in a company, both in terms of the company's ability to remain in business and in terms of expected dividend. Financial gearing can affect the continuity of a company. It can also affect returns to equity shareholders. The more reason an equity investor needs to understand the financial gearing of a company. You just don't buy, you just don't invest in company shares. We don't just buy company shares because I love this company. I'm going to buy a company shares because my investment is safe and I have a guarantee of expected returns. The more geared a company is, the higher the level of gearing, the greater the risk that little or nothing will be available to distribute to shareholders in the form of dividends. If a company is highly geared, there is the risk that little will be distributed to shareholders in the form of dividends. Why? Okay, I just joined the class. What is prior charge capital? We have explained that. Prior charge capital is the addition of debt capital and preference share capital. I will still explain why we call it prior charge. I'm just joining the class. We are looking at capital structure. A good question. He said, what is prior charge capital? Why do we refer to debt capital and preference share capital as prior charge capital? We said where a company is highly geared, there is the greater risk that nothing will be available or little will be distributed to the shareholders in the form of dividends. The reason is because interest must be paid before dividends will be paid to shareholders. Prior charge. We have to pay interest to the debt holders before we can pay dividend to ordinary shareholders. Also, we have to pay preference shares dividends to the preference shareholders before you can talk of ordinary share dividends. That is why they are referred to as prior charge. Their charges must be taken first before payment is made to ordinary shareholders. Regardless of the company's profits, interest must be paid. and preference dividend must be paid. A high financial gearing. A high financial gearing, that is a company with high financial gearing, is at a risk. Such company is vulnerable to poor trading conditions. Where the business is not doing well, that is poor trading conditions. A company with high gearing ratio, where a company is highly geared, there is a greater variability in earnings to shareholders. The more reason the equity shareholders need to understand the financial gearing of a company before putting investments. Gearing ultimately measures the company's ability to remain in business. A high-geared company has a large amount of interest to pay annually. Your gearing ratios measures the ability of a company to remain in business. If a company borrows money and the borrowing is becoming too high, failure to meet the interest payments and the principal repayment as at when due may terminate the life of the business, and the shareholders' investments will be adversely affected. Okay. Please note that at any point in time, you are trying to advise a client to invest in a company, in a quoted company shares. You need to review the financial gearing of that company. Right? We said you can measure financial risk using financial gearing. You can also measure financial risk by using the interest cover ratio as well as debt ratios. You can compute the interest cover ratio with a view to measure the financial risk of a company. What is interest cover ratio? How do we compute interest cover ratio? What is interest cover ratio? Then how do we compute interest cover ratio? The interest cover ratio is the number of times the company's operating profits covers interest expense. The interest cover ratio. This is the number of times a company's operating profit. What is operating profit? Profit before interest and tax. The number of times a company's operating profit covers interest expense. It is calculated as the profit before interest and tax divided by interest expense. The higher this ratio, the better for the company. So we can measure financial risk using interest cover ratio. Lastly, we can look at debt cover ratio. Debt ratio. As a means of measuring financial risk. What is debt ratio? How do we compute debt ratio? The debt ratio, this is the ratio of total debt to total assets. It shows whether the company has sufficient assets to cover its liabilities. The debt ratio shows whether a company has sufficient assets to cover its liabilities. You can compute your debt ratio as total debt divided by total assets. Or you can compute as total liabilities divided by total assets. Multiply by 100. It is better where a company has sufficient assets. The company is in a better position. Where you have sufficient assets to cover your liability. But where your asset is insufficient to meet your liability, that company will be at risk. That shows higher financial risk. There's a question. I can't see the question. Somebody is trying to ask a question. Man, what is cost structure? Don't know what you mean by cost structure?
No. Somebody was asking that he just joined. What is the topic? So I replied cost structure.
No, capital structure.
Okay. Okay.
We are dealing with capital structure.
Okay.
All right. So we have itemized 3 ratios that can be used to measure the financial risk. 1 is financial gearing, 2 is interest cover ratio, then 3 is debt ratio. Our next discussion. How do we measure business risk? If you can measure financial risk, you must be able to measure business risk also. How do we measure business risk? Measurement of business risk. Recall, what is business risk? Business risk is the risk that a company may make low profits. A company may achieve a low profit or even incur losses due to the nature of the business the company is involved in. Please recall, we explained business risk. The risk that a company may achieve low profits or the company may even incur losses due to the nature of the business the company is involved in. To measure business risk, we can calculate the company's operating gearing. To measure business risk, who is this? To measure the business risk, we can use operational gearing. We can compute operational gearing. What is operational gearing? How do we compute operational gearing? Operational gearing, let me go to it. Yeah. Operating gearing, we also call it operational gearing, measures relationship between contribution operating gearing measures relationship between contribution and earnings before interest and tax. The relationship between the contribution and the earnings before interest and tax. That is the operational gearing. What is contribution? Recall, right? Your sales less variable cost. So the relationship between the contribution achieved and the operating profits, profit before interest and tax, shows the operational gearing. It indicates the degree to which an organizational profits are made up of variable costs. It shows the proportion of variable costs in the company's profits. You know why? If a company has larger amount of fixed costs, that company may be at risk. If a company is exposed to higher proportion of fixed costs, that company may be at risk. Let me ask you, why do you think that company will be at risk? Yes, Minister for Finance. If a company has too much fixed costs, why would the company be at risk?
Sir, I didn't get your question, sir.
Okay, Emmanuel, are you there? I'll come back to you. The question is, I said, operational gearing shows relationship between contribution and operating profits. It indicates the degree to which an organization profits are made up of variable costs as opposed to fixed costs. And I make a comment. I said, if a company has greater amount of fixed cost, that company may be at risk. Now the question is, why do we think that a company with higher fixed costs may be at risk? So I'm sure you have done PM in skills.
Okay, can I try?
Yeah, Emmanuel.
Okay, based on what I understand, a company having a high proportion of fixed costs implies that much money is being tied down rather than being used to purchase more inventory for resale, as the case may be.
Okay. You didn't eat it directly. Let's move on. Let me answer the question.
Also, sir, a high proportion of fixed costs will affect the profit of the company because it will be more than the contribution.
Okay. Okay. That's fair. Now the main reason is that cost is fixed. Whether you produce or you don't produce, you are going to incur the cost. If you have hired staff, now, based on salary, whether the company produce or you don't produce, you have to pay your staff. If you have rented a factory, the factory cost is fixed. Whether you produce or you don't produce, you are going to pay your factory rent. Such cost, if it is too high, could be a problem because such cost is not dependent on production. That cost is already fixed. A good example is the business rent. You must pay rent regardless of the volume of production. Is that better, please? Let's go on. How do we compute operational gearing? It's calculated as contribution divided by profits before interest and tax. Operational gearing is calculated as the contribution divided by your profit before interest and tax. What is the significance of this ratio? You multiply by 100. What is the significance of this ratio? 1, if the contribution is high, but the profit is low, this implies that the company has higher proportion of fixed costs. If your contribution is high, but the profit is low, it's an indication that that company has higher proportion of fixed costs. In this case, the business risk as measured by the operational gearing will be high, where you have higher proportion of fixed costs. your business risk will be high. Number two, if the contribution is not much bigger than the profit, it implies that the company has a low proportion of fixed costs. With low proportion of fixed costs, the business risk, as measured by the operational gearing, will be low. So when you compute your ratio and you observe that the ratio of the operational gearing is high, it's an indication that the business risk of the company is high. If this ratio is low, it's an indication that the business risk of this company is low. All right? We now move to the last aspect of our discussion. A quick recap of what we have discussed. We are looking at capital structure and theory of gearings. We have explained what is capital, types of capital, capital structure, risk, type of risk, the business risk and the financial risk. We have discussed measurement of financial risk. To measure financial risk, you can use financial gearing or interest cover ratio, or you can use debt ratio. Measurement of business risk. To measure business risk, you can compute operational gearing. The last aspect of our discussion is theories of capital structure. The last aspect of our discussion is the theories of capital structure. Any question, please? Any question, please?
Yes, I have a question. I have a question on this operational gearing. So I was not when you were talking, the line was breaking. So the only thing I picked was the formula.
Okay.
So I don't want to take it back, but I don't understand what.
Fine. Fine. Let's explain it. We said operational gearing is relationship between contribution and operating profits. The operational gearing is the relationship between contribution and the company's operating profits. It indicates the degree to which the company's profits are made up of variable costs. Operational gearing indicates the degree to which a company's profits are made up of variable costs as opposed to fixed costs. Now, what is the implication of this? Is that if your fixed cost is too high, that company may be at risk. It shows the extent to which our cost structure contains variable costs. If you have less fixed costs, the company is better off. You know why? You may have control over variable costs, but you don't have control over fixed costs. Under costing, we call it controllability concept. And non-controllability concept. Fixed costs. These are costs that we don't have control over. I hope it's better. Abutu.
Yes, it is. It is now. Thank you, sir.
All right. Okay. Theories of capital structure. There are two main theories that attempted to explain the impact of
Your line is breaking, sir. We can't hear you again. It's breaking, sir.
of changes in all right, please confirm you can hear me now.
Confirm.
Yes, sir. I can hear you, sir. Confirm, sir.
All right. Of course, occasionally we might have network glitch. Some factors may not be within our control, but we are going to try as much as possible to manage it. Now let's start again. The theories of capital structure. There are two main theories that attempted to explain the effects of changes in gearing on the weighted average cost of capital and on share value. Look at it. We want to look at it. We want to know the impact of changes. If there is changes in your capital structure, will this affect your cost of capital? And will this affect value of your company? The discussion we are trying to do now is, does capital structure affect companies, affect the cost of capital of a company, as well as the value of a company? We have two main theories. One is the traditional theory of capital structure. And we have the Modigliani and Miller theory. The traditional theory is also known as the net income approach. So let's start with the first one. The traditional theory argues that this school of thought argues that there's an optimal level of gearing for a company. The traditional theory of capital structure argues that there's an optimal level of capital structure. There's an optimal level of gearing. Please note, when we mention gearing, it simply means you are bringing debt finance. If I say geared, that means this company has introduced debt finance, debt capital to its capital structure. So this theory is saying that there's an optimal level of gearing for a company. This is the level of gearing at which the weighted average cost of capital is minimized. Meaning that, I hope you can hear me, please.
Yes, I
Hello,
can
guys.
hear you, sir.
Okay.
I can hear you, sir.
Yes, we can hear you.
Oh, thank God. Meaning that there's an optimal level of borrowing that a company must try to work to. You cannot just be borrowing money. There's a point where you must stop borrowing money. That optimal level is achieved once a company attains the lowest level of weighted average cost of capital. Once your work has gotten to the lowest level, then the company must stop bringing debt finance to the business. According to the theory, as gearing increases, please remember I said when we say gearing, as borrowing increases, that's what we are saying. As the company takes more debt, as gearing increases, the cost of equity will rise. The more the company borrows money, the cost of equity will rise. However, there is greater proportion of cheaper debt finance in the company capital structure. The cost of debt is cheaper than the cost of equity. Why? The reason is because the cost of debt will enjoy tax relief. If a company borrows money, you are going to pay interest. That interest is the cost of debt. By borrowing money and you pay interest, that interest will attract tax relief. The tax relief will be used to reduce the cost of debt. Hence, cost of debt is cheaper. So as a company is bringing more debt finance, the work will continue to fall. It will get to a point, the work will get to the lowest level. Once your weighted average cost of capital attains its lowest level, then you have reached the optimum level of gearing. At that point, you have to stop bringing debt finance. At the point where your work is minimized, the value of the company is maximized. So in summary, the traditional school is saying that a company capital structure will affect its cost of capital and its market value. The conclusion of the traditional school is that a company capital structure will have impact on the company's cost of capital. Your cost of capital is your weighted average cost of capital. And your capital structure will affect your market value. That is the conclusion of the traditional school. So, in summary, companies should take advantage of debt finance because debt finance is cheaper compared to equity financing. But company must know when to stop adding debt finance. At a level of gearing where the work is at minimum, then the company must stop adding debt finance. Please go over this theory again. Okay, we are still on it. We have not finished now. So we have not finished. So we are still going to refer to it. Okay, look at the theory, the summary of the theory. The theory is saying that, okay, look at it. The conclusion of the traditional school is that an optimum capital structure exists at which the work is minimized and the value of the company is maximized. In summary, based on the question that we should go over it again, is that a company is allowed to borrow money. Once you borrow money, that means you have introduced debt finance to your capital structure. By borrowing money, you have cost of borrowing. Your cost of borrowing is your interest element. Once you start borrowing money, the cost of equity will rise. You know why? Because equity shareholders will demand additional return to compensate them for the financial risk associated with debt finance. By bringing in debt finance to the business, that means the company has introduced financial risk to the business. That financial risk means that equity shareholders' risk has increased. Because the shareholders' risk has increased, the shareholder will demand additional return. Hence, cost of equity will rise. But cost of debt will be cheaper. Because the proportion of debt finance is higher and the cost is cheaper, the weighted average cost of capital will continue to fall. It will get to a point of gearing. The WACC will attain minimum point. Any attempt to bring debt finance, then the WACC will just rise up again. Once you get to that minimum point, the question is, stop adding debt finance. That minimum point is the optimum point of gearing. That was the explanation we gave. The second theory, Modigliani and Miller theory, in brackets, ignoring taxation, no corporate tax. We have M and M theory, known as the Modigliani and Miller theory. In the absence of taxation, Modigliani and Miller developed a theory of capital structure to challenge the position of the traditional school. Modigliani and Miller developed a theory of capital structure to challenge the position of the traditional school. They argue that if there is no taxation, capital structure or level of gearing will not affect companies' market value and will not affect the company's cost of capital. Look at the argument. The argument is, in as much as there is no corporate taxation, a company's level of gearing will not affect the company's cost of capital and hence will not affect the company's market value. If you like, finance your business with equity. If you like, finance your business with a combination of equity and debt in whatever proportion you like. The cost of capital will not be affected. Hence, the WACC will remain the same. Once the WACC remains the same, value will remain the same, provided there is no taxation. If you look at the logic is, according to the, let us assume we have two companies, company A and company B. Both companies are in the same line of business. They have All right, please confirm you can hear me now.
Confirm.
I can hear you, sir.
Okay.
You,
Okay, sir.
Okay, thank God. It's better now, Abby. We're almost done.
Yes, sir.
It's better, sir.
Okay, let's go on. We are trying to use an illustration here to explain Modigliani and Miller theory. The theory says that how a company is financed does not matter. If you like finance your business with equity only, if you like finance your business with a combination of equity and debt, that will not affect the market value of the company. Provided there is no taxation. We are not looking at two companies. Company A and B. In the same line of business, company A is financed by equity only, 100 million. Company B is financed by equity and debt. Equity value 50 million, debt value 50 million, 100 million. The two company has gotten 100 million. The same value. In as much as the level of gearing increases, the greater proportion of Please, let's continue. I think it's a bit, I just pray we finish. Network is a bit fluctuating. But I'm hoping we are going to round up. Let me go ahead. So he's saying that if a company borrows more money, that means the company has greater proportion of cheaper debt finance. The cost of equity will rise. The cost of debt will fall. That means the rise in the cost of equity will be offset by the reduction in the cost of debt. Therefore, the weighted average cost of capital will remain unchanged. At all levels of gearing, the WACC will be the same. In as much as the WACC is the same, then the value of the company will be the same, whether gears company or ungears company. That is the position of Modigliani and Miller without corporate taxation.
But in reality, it's not true.
And that was why we call it theory. There's a theory. In reality, the theory will not stand because company will pay tax. But these guys have come up with a theory to define a simple economy without taxation. The argument of M&M, ignoring taxation, can be summarized as two propositions. The argument of M and N. Ignoring taxation, we can summarize these as two propositions. Proposition 1, the weighted average cost of capital is constant at all levels of gearing. What that means is that the work of a geared company is the same as the work of an ungeared company. Please note this down. The weighted average cost of capital of a geared firm, a firm that is financed by equity and debt, is the same as the weighted average cost of capital of an ungeared firm, provided there is no taxation. The total value of a geared firm is the same as the total value of an ungeared firm. Please note it down also. Provided there is no tax, the total value of an ungeared firm equals the total value of identical geared firm. VG is equal to VU. Value of a geared firm is the same as the value of an ungeared firm. Proposition 2, the cost of equity in a geared firm is higher. Please be locking this thing down. The cost of equity in a geared company is higher than the cost of equity in an ungeared company. The cost of equity in a geared firm is equal to the cost of equity of an ungeared firm plus the financial risk premium. This is the mathematics here. KEG, cost of equity of a geared firm, is equal to KEU, cost of equity of an ungeared firm. Plus, let me take this, let it be here. Plus into brackets KEU minus KD, close the bracket, multiply by value of debt divided by value of equity. The cost of equity of a geared firm is higher. It's higher because the geared firm is exposed to the geared firm is exposed to financial risk as well as the business risk, while ungeared firm is exposed to only business risk. This is the position of M&M, provided the company is not going to pay tax. What will happen if there's taxation? So the question will be, like Minister for Finance said, what will happen? In reality, this theory cannot stand because companies will pay tax. Corporate taxation will apply. With corporate taxation, debt finance becomes cheaper. Is that point clear, please? So that takes us to M&M, allowing for corporate taxation. Any question, please? Let's see, there's a chart. If there's any question, let's know. Let me check the chart. It's not due to network. Oh. It is not due to network. Because after the network server, I've explained. Let's see when we get to Modigliani and Miller, allowing for corporate taxation. M&M without corporate taxation lead to the conclusion that gearing is irrelevant. It does not matter how a company is financed. But in reality, most companies are geared. Many companies are geared. M&M revised their model. Modigliani and Miller revised their model to include corporate taxation. Modigliani and Miller revised their model to include corporate taxation. The inclusion of corporate taxation significantly changed their analysis. The inclusion of corporate taxation significantly changes their analysis. With corporate taxation, the interest payable on debt is tax allowable. With corporate taxation, the interest expense payable on debt finance will enjoy tax relief. This tax relief will be used to reduce the cost of debt. Therefore, Modigliani and Miller concluded that geared firm has advantage over ungeared firm. The geared firm will have advantage over an ungeared firm because the geared firm will pay less tax. That tax relief will be used to reduce the cost of capital. That means the cost of capital of a geared firm will be lower than the cost of capital of an ungeared firm. When your cost is lower, your value will be higher. If your cost of operation is lower, if your cost of capital is lower, that will enhance your value. Hence, the value of a geared firm will be higher than the value of an ungeared firm. That is the position of M&M with corporate taxation. That position now takes us back to the traditional school. That is, as gearing increases, there's greater proportion of cheaper debt finance. In the company's capital structure. The cost of equity will rise normally once gearing increase. As you are bringing in more debt finance, the cost of equity will rise, the cost of debt will fall. The overall cost of capital is your WACC. WACC will continue to fall. In as much as the WACC is falling, value of the company will continue to rise. So M&M concluded that with corporate taxation, the company should take advantage of debt finance. Finance your business with debt capital as much as practicable, so as to take advantage of cheaper debt finance. That was the conclusion of M&M, where there's corporate taxation. He's saying that once a company is liable to pay tax, then that company should finance its business with debt finance. Because debt finance will enjoy tax relief. With tax relief, the cost of capital of the company will fall. With fall in cost of capital, then the value of the company will rise. I hope this point is clear. We can summarize M&M arguments, allowing for corporate taxation as two propositions. Look at it. Proposition 1. The WACC falls continually as the level of gearing increases. What is gearing? borrowing. As your level of borrowing increases, your weighted average cost of capital will fall. That means the cost of capital of a gears company. What is a gears company? A company that is financed by debt and equity. The cost of capital of a gears company will be lower than the cost of capital of an ungeared company. So it's better to finance your business with debt. If your cost of capital is lower, your value will be higher. You know, it's logical. If your cost is lower, your profit will rise. The rise in your profit will add to your value. We must try to unlock what this theory is trying to say to us. Beyond passing the exam, look at the formula here. The work in a geared company is lower than the work in an ungeared company, an all equity finance company. The formula will change slightly. The work in a geared company is equal to the work of ungeared company, bracket is a bigger bracket. 1 minus dt divided by d plus t. Your d is value of debt. Your e is value of equity. The letter t here is the tax rate. Do not be disturbed by the noise of the formula. By the time we come to the application, it should be easier. So we are going to adjust this now to introduce bracket, open bracket, 1 minus dt divided by d plus e. The total value of a geared firm. What is a geared firm? A geared company financed by equity and debt, is equal to the total value of an ungeared firm plus the value of the tax shield, the tax advantage. The tax advantage is here, look at it. Value of a geared firm is equal to value of an ungeared firm plus debt multiplied by tax. The amount of debt multiplied by the tax rate is what we call the tax shield, the tax benefits. Lastly, the cost of equity in a geared company is higher than the cost of equity in an ungeared company. The only thing that will change is to introduce terms to this formula. Cost of equity in a geared firm is equal to cost of equity in an ungeared firm plus the financial risk premium. Your financial risk premium is 1 minus tax, close the brackets, multiply by open another bracket, cost of equity of an ungeared minus cost of debt, close the bracket, multiply by value of debt and value of equity. For simplicity, value of debt. I just introduce V over value of equity. Let me borrow this one first. If you look at value of debt over value of equity, that is your financial gearing. How do we compute financial gearing? Value of prior debt capital over value of equity. Those are the two main theories that we have. Any question, please?
Yes, sir. So, sir, questions relating to this capital structure, are they both theoretical and computation?
You are very correct. It's largely computation. They will build it into your cost of capital.
Okay, thank you, sir.
All right, let's try to round up in 10 minutes. We have other theories, but the major one has been discussed. We have the static trade-off theory. We have other theories of capital structure. One of them is the static trade-off theory. This school of thought argues that for each company, there is an optimum capital structure with an optimum level of gearing. They are saying that we have an optimum level of capital structure. That optimum level is achieved. It's a trade-off between benefit of debt finance and the cost of higher indebtedness. That there must be a trade-off. You are going to compare the benefit you get from debt finance with the cost of taking more debt. At a point where the marginal benefit of debt finance equals to the marginal cost of debt finance, then you have achieved optimum. That is the position of the static trade-off theory. The benefit of debt finance are mainly the tax relief that is obtained on debt interest. The tax relief on debt means that the company's work will fall as gain increases. So once you achieve the marginal benefit of debt finance equals the marginal cost of additional debt finance, then you must stop adding debt finance. That is the optimum level. Whether they are correct or not, it's not the argument. They are just saying, the theory is saying that there is a capital structure. There is an optimum level of capital structure. That optimum level of capital structure is achieved at a point where the marginal benefit of debt finance equals the marginal cost of debt finance. We equally have the pecking order theory. Pecking order theory of capital structure takes a different view of gearing and method of financing. The pecking order theory challenges the static trade-off theory. The argument of the pecking order theory was that there is no optimum level of capital structure. Rather, a company should have preference for financing. How you finance your business should be in such a way to reduce your cost. If you want to finance your business, there's an order or there's an order of preference. Your first choice is to finance your business with retained earnings. The source of finance that is preferred most is retained earnings. Why? Because retained earnings are readily available finance and there's no cost involved. The money is already in your hand. What is retained earnings? Part of the company's profit that is not distributed as dividends. So if you want to finance a project, you can start with your retained earnings because it's cheaper. It's the most preferred options. When you are done with your retained earnings, then you can consider debt finance. That is the second level of finance. When you are done with debt finance, you can now consider equity financing. This order of financing will minimize the company's cost of capital according to pecking order theory. The last one is market timing hypothesis. That is the market timing theory. What this theory tries to summarize is that your choice of financing, the choice of financing method for companies can be driven by the opportunities in the capital markets. The market timing theory states that the choice of financing method for companies can be driven by the opportunities in the capital market. These opportunities occur because of asymmetries of information. It is believed that the company's managers have better information and they have more information to know the appropriate type of capital to use. The company's manager, they are in better position. They have access to better information that will assist them to know the appropriate time to issue equity, the appropriate time to use debt finance. Management should know when the future prospects for the company are better than the investors. What the theory is saying is that the management know when to use equity finance to take advantage of the opportunities in the capital market. The management knows when to use debt financing. And they will do that where there's opportunities or where there are opportunities in the capital market that they can leverage on. So the capital structure of a company will depend on the opportunities available at the capital market that the company can leverage on. As a business organization, you should know when to issue equity shares. You should know when to apply debt finance. That is the concept of market timing hypothesis or theory.